All right. We're going to be starting with a brief overview of what we're going to be covering today. I'll first give an introduction of just freight futures in general, what they are, how they function, and just what to pay attention to when looking at these contracts. I'll then go through an industry adoption case study. So I'll be talking about, obviously, an anonymous client of ours who has been using these contracts for about a year now, just to give you an idea of how this functions in real life. And then we'll go through essentially a few things to consider if you're looking to get started. Again, what kind of things to pay attention to, how to actually set this up, who to talk to. And then I'll hand over to Johnson, who is joining us from Linerlytica, and he'll be covering a few more details on the freight futures market in general, and also the different contracts that are available right now, and especially some of the relevant information about these contracts that is going to be important if you are thinking about using any of these later on. And then at the end, as mentioned, we'll be having our Q&A. So any questions you have, just save them for later, and then we'll go through all of them. Now, freight futures. Well, there are quite a few different contracts available right now on different exchanges in different countries, and there's even more coming out early next year as well. However, they all work on the very same principle. They are purely financial hedging tools. That means if you are purchasing a futures contract, you're not getting any physical cargo space. It's, again, purely on the financial side. They are really meant as risk management tools to essentially deal with freight rate volatility. So that means if your prices are fluctuating too much, they offer you a financial way of locking in that price, not a way of actually getting physical cargo space if you're looking to ship something and you haven't secured your space yet. As a result, it's very important to combine these futures with a physical spot market or index-linked contract that actually secures that space that you're looking for as well. So it's essentially a two-pronged approach to making sure you can get your rate and space together. Now, with that, the question is, what's the point of this? I mean, we already have fixed rate contracts. Are we just giving you the same thing again in a more complicated way? Well, not quite. Well, in the end, we are looking for the same outcome as a standard fixed rate contract on the physical market. The way we get there is a bit different, and the way it works in the end is also somewhat different, with hopefully a somewhat more convenient outcome for all parties involved. The reason we are interested in these contracts, or the reason they've been launched, is that I think, as everybody in the industry knows, fixed rate contracts aren't always very fixed necessarily. And especially in the post-COVID period, we could see that fluctuations that in previous times have been measured in maybe hundreds of dollars per container are now being measured regularly in the thousands of dollars per container. So volatility has remained very high, even since COVID, obviously not talking about anything that happened during COVID itself. And this simply means that fixed rates, whenever they are agreed, can very easily move very, very far away from the prevailing market rate, leaving both shippers and carriers quite unhappy, with shippers potentially feeling like they're overpaying if rates drop significantly, or carriers feeling like they could get a much better deal by just, offering their space in the spot market instead if rates rise. Ultimately, both parties in this transaction are unhappy. And the result, as everybody knows, is that these fixed contracts essentially need to be either negotiated once again, everybody's spending a bunch of time and effort on that, or they just end up, basically turning into, toilet paper, perhaps. Now, this is ultimately where index-based contracts can come to the rescue. The idea of an index-based contract is that both parties agree to a common reference rate that basically indicates, okay, where do all of us agree the spot market is? And then both sides will pay and receive a rate that is in line with this market. This is the simplest way of setting this up. Obviously, there are slightly more complex setups here, but we're going to keep it simple just for this case here. Again, any questions, welcome to ask later. The next question is then, which index? Well, I mean, there's a bunch of indices from different providers, again, from different regions, focusing on different trade lanes. What all of these have in common is that with these contracts, or rather using these indices, and then an index-based contract for that, you can lock in your guaranteed cargo space, and both parties would fundamentally be happy with that, since they will always be paying and receiving the spot market rate. So there's no reason to ever break that contract. Again, this is great. You now have your guaranteed cargo space, but it still leaves you exposed to volatility, because if rates change, again, the whole reason we have this discussion is, well, at this point, cost expectations. If you're planning for the next year, your income as a carrier or your costs as a shipper, all of that is going to go out the window if suddenly somebody in the Red Sea decides to turn on their rocket launchers again. So this leaves us with the issue that planning ahead remains impossible with just index-based contracts. And this is finally where freight futures come in as a way to finally fix those fixed rate contracts in a sense. The idea here is that as a shipper with your index-linked spot contract or index-linked or spot contract, you have your guaranteed space at an uncertain price, and futures essentially do the complete opposite of a physical market contract. They give you a guaranteed price, but no space. They're complementary, so that means if you put those together, they will essentially form a complete fixed contract for you. But at the same time, the counterparty on the physical side will still receive whatever the market rate is. So again, you get the benefit of a fixed price, but your counterparty has no motivation, no incentive to ever break out of that contract. So this way, you finally get a proper fixed rate contract where both your space and your price are guaranteed. Now, this is exactly what one of our clients has been doing for about a year now. The client is a European manufacturer and distributor of consumer goods. They're based in Western Europe, and they are importing significant volumes from China. Particularly during COVID, they obviously faced, like most shippers, significant supply chain disruptions, and obviously this massive spike in freight rates. They came to us with no prior experience of futures trading, but they were just looking quite desperately for some way to manage essentially unpredictable freight rates. The solution was then to essentially look at the INE EC freight futures contract, which is a contract listed in Shanghai and covering very specifically the Shanghai to North Europe route. And essentially, we worked very closely with that client. We first of all set up a simulated trading environment so they could try some strategies sort of in the virtual world without actually risking any money. In addition to that, we worked with them to determine how closely their historic freight rates actually correlate with the contract itself. Since obviously, if what you're paying on that trade lane doesn't match what the contract is settling against, it's going to make it very difficult for you to actually hedge using that contract. And then lastly, we obviously had to talk to them about how futures work, how to just effectively use them for risk management, what are the things to pay attention to essentially when you're just doing this operationally. And as a result, they started really with very small hedges in early 2025. So we're really talking just a very small portion of their overall trading volume, really to just gain some experience. And over time, as they became more confident, they gradually grew their position size. So they essentially opted to hedge a larger and larger percentage of their container freight. They continued all of this even as rates began to fall, meaning they essentially locked in a relatively high price earlier in the year. And the result is that in the financial market, they now actually lost money. Now, obviously, they benefited in the spot market from actually paying lower rates. So as a result, they got a fixed price. And while somebody who didn't hedge, in this case, could have benefited from actually just paying the lower and lower spot rates, ignoring the occasional freight rate spike earlier this year, they simply prioritize predictability and risk reduction over possible short-term gains, because their consideration is that, sure, this year rates might be falling, next year they might be rising, or perhaps the year after, depending on what Johnson tells us later. But fundamentally, the key takeaway here is that the use of EC futures helped them transform essentially extremely volatile freight rates over which they had no control into manageable and predictable expenses for which they could plan ahead for the rest of the year. And on the right, you can see the logic is really very straightforward. Essentially, you try and create the opposite position in the financial world to what you have in the physical world. In the physical world, you're buying your container space, and if spot rates rise, you're paying more. On the financial side, what you're doing at the same time is you're buying a futures contract, and if the futures contract rises together with freight rates, then you're earning money in the futures market. If the opposite happens, you're saving money in the physical market, but you're losing money in the financial market. But overall, these two will always cancel each other out. Not perfectly. We can see the correlation here is 0.95. So it's not a 100% hedge, but it is a significant improvement over what you would have otherwise. And the idea really is just to get a price that remains locked in regardless of where the spot market is moving. Now, if you're now thinking about, okay, how do I get started? Well, here are a few points to just consider about why this client is currently in this market. Why are they doing this? Why are they benefiting from this? And why do they see this as something that is valuable? Well, this client specifically has four sort of factors that I determined. Firstly, they are a price taker in the freight market. They're not large enough. They're not IKEA or some other very large company that has negotiating power with a carrier directly. They essentially need to accept whatever rate is being offered in the spot market. So that means they are really paying in the physical market exactly what the futures contract is setting against. At the same time, for them, predictability is something they value. Especially following COVID, they just don't want to risk anything like that again in the future. They want to have the ability to just budget ahead for the next year and get that price locked in. And then the third point is that in their sector, they need to be reliable. They need to deliver when demand is there, and they can't afford to risk losing market share because somebody else will deliver instead. That means when they need supplies, they need to ship those supplies in. They can't just wait for a better price. So again, this combines with point one, they are price taker. And so if the price is high, that's what they need to pay in the freight market and in the spot market. And lastly, at this point, they have gained experience. They've been trading for almost a full year now. They've become very familiar with how this market operates and how they can integrate their INE EC hedging operations into their overall freight operations. So overall, I'd just like to point out that companies have different priorities, different market positions, and different negotiating power. Futures can be a very valuable tool here for risk management for companies that seek predictability and that are looking for a way to really reduce their freight risk. In general, if this is something you are considering, there's a few points to think about. First of all, correlation. As mentioned before, not everybody is paying the same rate on the same trade lane. If you want a successful hedge, you first of all need to make sure that what you're paying is actually correlated to the contract you're looking at. And again, there's different contracts for different participants on different trade lanes. So these are all considerations when looking at this. But this is the first most fundamental step, and this is something you especially want to probably work together with your broker on. The next point is liquidity and market depth. Again, different markets operate very differently. There are some that are at this point completely electronic. There are others that rely purely on voice trading, essentially a more traditional way of doing these trades. And then there are some that are mixed. This is changing over time. But again, even across all of these markets, liquidity, so basically the amount of trades being executed, also differs significantly, even just throughout different times of day, because obviously somebody in Asia might be looking to trade at different times from somebody in Europe. So that means depending on where that contract is being traded, you may need to trade at a different time as well. And then in other markets, again, it is perhaps easier or more difficult to get in and out of positions very quickly at whatever the price is that is currently prevailing in the market. So that is liquidity and market depth. The third point is your risk tolerance and priorities. Again, a hedge can provide very strong protection against volatility. But there are people in the market that are willing to just take a larger degree of price risk. And if they have to do this, then they have a different consideration here. Maybe they are looking for a partial hedge. So that means instead of hedging all of your container freight, you can just do 10%, 20%, 50%, and basically just take out some risk. Or on the other hand, if you're seeing, okay, perhaps Johnson is telling me that there's a lot of supply of new ships coming in the market next year, perhaps rates are going to be falling. Maybe I want some exposure to spot rates because I think they might be falling. But at the same time, I don't want to bet, essentially the farm on all of this. So I'll try and lock in at least the other half of my business there. And then lastly, when you're about to get started, make sure to test. Work with your broker, get some historical data, and match this essentially with the historical market data. Try it out in a virtual environment. Usually this is something that your broker would provide for free, certainly we do. And it just offers you peace of mind to essentially try it in a safe environment before you do it with actual money in the actual market. And again, your broker, the person essentially helping you get to the exchange, will be able to assist you with this. Now I'll hand over to Johnson for a freight market update and a few more details on the different contracts available in the market.
Right. Okay. I think we go to the general market update first. Yeah. So before we swap to. So yeah. Okay. So I showed some of the data that in Linerlytica that we track closely. It's not so much about the outlook for next year, but this kind of data is more applicable for people who try to estimate if the next GRI, like in December, January, will take off or will stick. This is a utilization. Basically, every dock is up until I think the latest data point that we have from yesterday. So every dock is a departure of a vessel. So we take the draft for the vessels at the last. I mean, the reported draft at the departure from the last loading point in Far East. Comparing to the vessels decided draft to make this kind of data series. So a clear trend of coming off. We can see the dark colors premier, and then the light greens are the independents, mostly MSC's vessels. And then the gray one is the Ocean Alliance. Ocean Alliance tend to be a bit better, but recently we also see some of the loading Ocean Alliance is quite low. And then the Gemini in red. That's more or less in the middle. So, but then there's a trend of coming down. And then here's the average of all the docks. The blue lines are the average of all the departure, and the red is the average for the Alliance's vessel. So the blues are more representative because they include the MSC. So clearly it's a kind of coming back to not too far from the low of the October. So that's why we see the liners quotations sort of they call high for the longer date departure. So they're calling for GRI for December, but in the near term, the recent couple of weeks they've been cutting the freight rate quite aggressively. And then this one's another one that we track. Utilization, despite that we get the data up until 20th November, is still kind of better looking at this one. So the liners capacity deployments in the Asia Europe. So this one's a bit more forward-looking. So utilization not so good. So we are hoping for. I think the market is hoping for the volume to pick up before the Lunar New Year. But then you also have to take into account that the liners capacity deployment also trending up as well from November to December. So the January figure is not here. So I probably put it in the next chart. So in the details. So it's actually quite high for December capacity. So it's actually close to 320,000, quite comparable to the peak in August. And then also much higher than last year's December here. So back then there was around 300,000. So it's about 5% high year on year. So that also is if we are hoping for the volume to be stronger to push up the freight rates, then we also have to take into account that the capacity also sequentially is much higher. And here's the table that we usually publish on a weekly basis. The January last week is the figures not completed yet, so because some of the liners don't provide a schedule that far ahead. So these kind of blank sailings are not definite. So, but then we look at from the last week of November, which is next week, until or 5 weeks in December and the first couple of weeks in January. The weekly capacities are mostly about 300,000. So that is also put a question mark. Usually, so the pre-Lunar New Year cargo rush will last for about 4 weeks. But this year, the volume recovery, it came slightly earlier in October. So when this pre-Lunar New Year sort of a seasonal peak spread out too wide, I also think that it may not last that long. So that also give us another question mark about the tail end of the pre-Lunar New Year cargo volume will still be as strong as the liner would have hoped. The liners are definitely hoping for stronger volumes for the GRI as well. So this is Asia to North Europe. So we took a look at the sentiment indicators or leading indicator for the container shipping market, which is the Far East West Coast. The utilization also come down. The last week's a small bounce, but it's still at the low, especially for the total utilization. And then for capacities to West Coast, there's been some adjustments, so it's not as high as the peak season in summer. But we all know that the freight rate now in Trans-Pacific are rolling over even quicker than the North Europe. Now, so what I heard most recently, the forwarders are getting the rates around 1,400 for FEU to North America. So to North Europe, still like 2,000, low 2,000, but the lows that we heard is around like 17, 18. But then to US West Coast are down to 14. So there's a lot of reason for liner to adjust the capacity. So some of the trader or some of the procurement managers, they would think that the brand sailings may be reasons. Sometimes brand sailing will help to push up the freight rate, but usually a real freight rate up cycle don't come from the brand sailing. So usually brand sailing is a confirmation of that the liner seeing that the market is really not that strong. And then this one's a detail of which service we may see some branching. I don't put January here especially for oceans because we don't have the data that far ahead. But then so you look at December, November and December. It come off a bit in December, but it's still I think could be challenging. So we generally so far since the middle of 2024, so we have been on the down cycle. Definitely. Next year, the new capacity increase is lower than this year. The next year's new capacity increase will just be around 3-4% to the total fleet. But then we have a huge delta about the return to the Red Sea factor. That we have seen the liners gradually returning to the Red Sea or testing the return to Red Sea. So liner meaning that the CMA CGM. So if the come back to Red Sea, so that would be around a 5-6% capacity that could be released. But likely, so I think the return will be more gradual. But then the return also would put a kind of upside hedge to the market. If the market is good enough, then the liner will get a lot more incentive to redeploy the vessel back to the Far East sooner, so to increase the vessel turnaround time. So then that will encourage them to use the Red Sea. So we will see, but near term, I am not like super sure. So if we see further increases or a big increase in the freight rate in the next 2 months. I did use about 5 minutes to go through a bit of details about the key product now is being available in the market. So the first columns are the earliest product that's being listed in the CME and SGX. The second one is the one currently listed in Shanghai, it's a future exchange, the INE. And then the third column here is the one to be launched in Euronext. That's based on the Geneta's index. And then the last column is the one that to be launched in the ICE. So one by one, this one has a bit longer trading track record. And then these two originally, so they talk about launching it end of this year, but now look more likely to be in the 1Q next year. And then Euronext, I think they will make announcements soon. So it look more likely to be somewhere around February, end of February. We will see. More products are better for the industry user and for the trader. Right? So you get more options to use. And then when we're deciding which one to use, definitely the index is very critical. They are all using different indexes. So for hedging, the premises of how we call an effective product is about if the index is as close to the reality, meaning the index same as what we pay to the liner or what the liner earned from the customer, the settled rate, as close to settled rate as possible. So the Shanghai SCFI, SCFIS, and also the ICE based on the NICE index, they both are using the paid freight rates. But then my take about a lot of these indexes is, from the user's point of view, we actually cannot really judge which one is a better index. So, especially for analysts who doesn't have like us, doesn't have all the access to the entire actual paid freight rate or bill rating data. It's very difficult for us to judge. But even for users who are paying the liner directly, so sometimes they're also not sure if what they pay to the liner is representing the average of the market settled the price. So to judge which index is better, so if it's a settled or quotation, so then it's very difficult. So my verdict for which one's a better index is, there's actually no better index. So put it this way. I know that this statement will invite a lot of arguments from other analysts. My take, there's no better index, just because it's so difficult to judge. So, but there are more popular index, meaning so there's some index being used more commonly in the industry than the others. So if an index being used more widely, eventually that becomes the settled price. So index is something that whoever take the lead, whoever being used the most, eventually become the index that's the right index. So unfortunately, I have to say, out of all these four products, none of them are based on the index used in the so-called index-linked contract. So the more common. So the most popular index in the index-linked contracts are the SCFI, which is not being used by any of these future products here. So that's one point I want to point out. So the other ones are the track record, right? When everyone called it, when the new index being launched, then you have the index owners and their affiliated analysts who claim that the index being better. But it's hard for us because they all call their index being better. So, but then one thing I found also interesting is that most of them will also benchmark their index back to SCFI. So it's also about how highly correlated they are with SCFI as a validation. So that's the dilemma that we are facing from user as a trader, right? When I look at it, the FBX is based on the freight rate being, I think, being traded or dealt with on the Frictos platform. And Frictos platform have a lot of small, medium-sized freight forwarders. So they do have an angle to represent the so-called spot market. Yeah, another challenge about making this index, it's not so much about their skill or anyone's, like we hear some accusation about the Shanghai Shipping Exchange is making up index, but they're no one to favor because the higher the index, so the worse off for the Chinese exporters, right? And they also have one of the largest shipping liners, so they don't need to favor any side. But then, yeah, it's not so much about any conspiracy, but it's actually making this index. One challenge is how you judge which set of a sample or data or bill rating are really representing the spot market. That's one challenge. The second challenge is the settled price in the market is actually very wide in our industry because the lack of transparency. So the quotation or the freight rate agreed in the same week or the freight rate being paid in the same week. So for what both parties consider to be spot shipment, sometimes could be very different. So that makes which one is being right index is a very difficult point to decide on. So Fricto is based on a lot of small, medium-sized freight forwarders dealing. And then SFIS actually based on a very large sample of a lot of input from the liner and forwarders bill ratings for shipment out of Shanghai. So they have a very large sample size. And also for Shanghai Shipping Exchange, they are actually the most experienced in making this kind of index. Their oldest container shipping index go back to about nearly 30 years ago. So then we look at Frictos and Shaneta, also have long track record relatively. So also only about 10 years, right? And then NiSHAT, so we just have the index this year. So third, the NiSHAT ones for me is we need to see a bit more track record to really do the kind of model to assess if their index actually really representing the market. But then again, we need to have a lot of actual freight rate sample data to validate it, which is a challenge for us to judge. And then for the contract side, so the one in SGX is only one FEU. The Shanghai one, because they use index instead of $1 per FEU, they make it more challenging to figure out what their index represent, and also what volumes in every lot of their contract represent. So, yeah, for one FEU, I think it's a huge advantage for inviting liquidity usually. So, but of course, liquidity also depend on other situation in the market. But then the Euronext 1.5 FEU, and then I just go quickly to the other points. The route that being covered, the Singapore ones cover all the four major East-West trades to North America, East Coast, West Coast, Europe, North Europe, so also met. And then they also have actually return leg as well. So and then the Shanghai ones are mainly at the moment only westbound to North Europe from Shanghai. And then Euronext and ICE, they come in to fill some of the gaps that the Shanghai is not providing to West Coast North America, so particularly. And then you can read the details. I just want to go through the highlight the most important part. The trading hours, the Euronext worth highlighting is they would the trading hours are here. Yeah, trading hours. Yeah, they started in the very early mornings, 7 a.m. In Europe, so it overlaps with the Asian afternoon hours. And then yeah, so ICE I think would be the US hours, but it's still to be determined. I need to highlight it. And then the last trading days, I think that what I worth highlighting is the settlement price. Settlement price for hedgers are very important that the contract cover the entire period of the contract or all the periods in any given through the years being covered. Because for container shipping, so most of the volume for the cargo owner and the liners go on weekly basis every week. So it's important that the price, eventual settlement price, also cover the entire period. Instead of like the Shanghai one, they only cover the last 3 weeks of the month. So then the volatility of the first week is not being covered here. I presume that the other 3 quarters, they all cover the entire period of the contract. And then this is a bit more informative stuff about what the ticker, the simple size. Margin also important. The Singapore one is a bit high because now if you know that the freight rate now is around like 1,400 the lowest to West Coast, and then the Europe a bit more than 2,000. So, but the Singapore one required that the trading margin to be like $800. That's nearly 50% to 40% of the entire contract value. So that has a cash flow consideration for a lot of the user for high margin requirement here. And then the INE 17, so it's kind of in line with also what Euronext is charging. So INE the Shanghai one have a daily moving limit. Singapore doesn't. So the other two to be decided. And then liquidity, yeah, Singapore ones are making record recently. So definitely, the launch of a new product bring in a more liquidity for the Singapore market. But then the bulk liquidity actually is happening in Shanghai. The market structure is very different. So all the other markets do not have as many as retail trader as Shanghai has. I think that eventually will continue to be a deciding factor for the liquidity. So because all the offshore market very depending on the institutional investor or trader or the industry user. And a lot of their marketing, I found that they still very much focusing on the industry user, which usually I don't think they really trade, even the user. So they may take a chunky position in one go and then sit on it. And then the fee I'm listing here, so I have to highlight that there might not be your eventual paying cost in using this future, because I just list out the exchange fee here. But usually it's below 0.2% for the value. So, but you need to negotiate with your broker. From what I understand, some fees here actually with your brokers are kind of a case by case, depending on your volumes and the type of trading behavior. Yeah. And then for executions, the Shanghai ones are totally digital. So you can trade it like usually how you trade a stock. But then outside of Shanghai, there's a mix of voice and digital trade mechanism. For people who don't understand the voice and digital trades, the exchange have an IT system that match the buyer and seller. But if you have to trade via the voice broker, the voice had to find, if you want to buy, the voice broker need to find you a seller to do the match. So it's a match by human. And the rest is a bit more informative stuff. So we will put this entire video on on the link, right? Eventually, you can come back to it and look at the details. I may just stop here for any question.
Yeah, I see. We're sorry, getting a bit late anyway, so I'll just very quickly head to the Q&A section. We've had a few questions submitted already earlier, so I'll just very briefly answer those. Obviously, if there's anything else you would like to know, do feel free to just put it in the chat or just reach out anytime later as well. And we've got our contact information on here later as well. Just very briefly, we had a question about liquidity from somebody who just put it in earlier. Liquidity, basically, where does it come from? It depends. It's different across different exchanges, but fundamentally from your counterparty. So for every buyer, there's a seller in the market. And fundamentally, if you go in there as an industrial participant, obviously a shipper is going to be on the opposite side of, for example, a carrier. Freight forwarders might be on both sides. And then obviously you have speculative traders in the market as well. The fundamental logic is that hedgers go in the market to essentially take risk off, speculators to go in the market to take on risk. And that's essentially why you want to have both in that market, to bring those together and make sure that people who want to avoid risk can transfer to people who are willing to take on risk, with the hope, obviously, of making a successful bet on the direction of the market, usually. The second question was just very generally on who are these contracts for? Are they limited to shippers? Are they more for carriers, forwarders? Who can actually use them? The answer there is, I think, as maybe mentioned during the case study earlier, it very much depends. Fundamentally, every party in the industry can benefit from hedging if essentially price risk management is what they're looking for. So that means as a shipper, if you're concerned about prices going up, well, you can hedge. As a carrier, if you're worried about prices falling, you can hedge. As a forwarder, very frequently the issue there might be that you have a time difference between when you are securing your cargo space and actually providing or guaranteeing that cargo space to your client. So you might just want to lock in rates over time in between buying and selling your cargo space as well. So really, there is a logic in there for everybody. The question, again, is only about finding the right contract, the right index, and making sure that what you're paying is actually close enough to what you see essentially in the index to make sure that you can successfully hedge. But very fundamentally, anybody who is in that market who wants to manage their risk, price risk specifically better, can, in theory at least, consider hedging as a way to do that. And then I think the last question, I'll perhaps let Johnson answer that one, is just regarding the outlook, I think very specifically for the China and India trade.
Okay, so 1 year ahead, I had to be honest, I don't know. I seldom tell people what I think about 1 year ahead, because there's so many variables, and the demand supply, even the supply side. So we know all the new buildings, but you don't know the vessel turnaround time and all this, how the world evolve, and port congestion and all this, right? We play into effect about vessel turnaround time. So in short, I don't know 2026 Indian rate. I actually don't even know about the Asia to North Europe or Asia to West Coast North America. So those routes that we track very closely. But I do see near term the freight rate to India will also be soft, just because for the Asia Europe the data point that I just shared with you. So because they all both are westbound, right, from Far East, sometimes they share slot on the same vessel. For Asia, Europe, and India, I think they are kind of bundled together in a lot of ways on demand supply model. So the near term, I see the capacity trending up, just like in the Asia Europe. That will put a cap on a big freight rate increase. Near terms for also India, we also see the utilization actually that the last. For India, it's not just the Asia Europe you roll over the last couple of weeks, but India has been soft for nearly a month. So I don't think that India would have any better luck than Asia Europe.
Okay, with that, I don't see any further questions in the chat. So if there's anything else you'd like to know, feel free to reach out. You're very welcome to send me an email. If you have anything for Johnson, we're going to share the slides and all that later, the recording as well. So our contact information is in there. If there's anything we can do for you, don't hesitate. And with that, yeah, thank you very much for joining us.